and welcome to today's webinar. My name's Jo Morvan. I'm the Editor-in-Chief of ACCA's Accounting and Business magazine. Today we're going to talk about planning for indirect tax, looking at global indirect tax trends and sharing VAT, GST and e-invoicing regulatory updates. Joining us today are Alex Bauf, he's Avalara's Senior Director in Global Indirect Tax for EMEA, and Reece Duncan, who's Lead Solution Consultant at Avalara. Before we get started though, I'm just going to run through a few housekeeping issues. So the presentation will be accompanied by slides that automatically change as our speakers present. If you find they're not progressing, you can refresh your browser. For PC users, that's F5, and Mac users, Command and R. You can access the slides from the resources area. We'd be delighted if you sent us in some questions, and you can do that at any time using the chat area on your screens. We'll go through those in a Q&A at the end of the presentation. The whole webinar will last about an hour. You can enlarge the slide area of your screen by grabbing and dragging the bottom right-hand corner of the slide area window, and there's a help button if you have problems with the technology. Finally, turning to CPD, if you're an ACCA member, you can count this webinar towards your CPD if it's relevant to your career, if you can apply the learning in the workplace, and can provide evidence that you've joined us today. For that evidence, we have provided a personalised CPD certificate, and you can access that via the certificate icon in the middle of the tray at the bottom of the screen. So that's it for the introduction. Now it's time to hear from our first speaker. So over to you, Alex.
Thank you so much, Jo, and good morning, good afternoon to everyone, wherever you are joining us today for this webinar. This is our first webinar of 2023, the new year. It's probably too late to say Happy New Year, but I just have. This webinar is, are you ready for 2023, the year ahead in global indirect tax? We are going to do a very fast-paced round robin around the globe, pretty much touching every single region, looking at various updates, everything from recent VAT, GST rate changes, other news and updates, and in particular looking at some new e-invoicing mandates that are coming in this year, as well as important changes that are coming up on the horizon in 2024, but really need to be on the agenda of all businesses and clients this year. By way of very brief introduction, my name's Alex Bauf. I'm Senior Director for Global Indirect Tax at Avalara. Have over 17 years experience within global indirect tax, spent within advisory consultancy with Deloitte and Grant Thornton in both the UK and the US. And I'm really pleased to be joined today by my colleague and guru, Reece Duncan.
Thanks, Alex, and hi, everybody. Good morning. Really excited to speak to you all today. My name's Reece. I lead our solution consultancy team here at Avalara. Likewise with Alex, I've spent around 11 years at KPMG doing indirect tax technology. So lots of experience within this space. Yeah, so nice to meet everybody. Over to you, Alex.
Thanks, Reece. And again, very, very quickly, to provide background about Avalara, if you don't know us, we've been disrupting the status quo of global tax management since 2004, headquartered in the US and Seattle. Today, we're very much a global tax technology company. We have offices across the globe, including our EMEA headquarters in Brighton in the UK, but also with offices in London, France, Germany, Belgium, Luxembourg, Romania, Turkey, Spain. I know I'm missing a few, but we're always expanding, always growing. We support over 30,000 companies globally, and we have pre-built integrations for various solutions across ERPs, e-commerce, marketplaces. Within tax technology, we're always looking to help our customers and clients achieve compliance, reduce their risk, and streamline process. And in terms of our products, our solutions that we have, it's the entire life cycle for indirect tax globally. Everything from obtaining registrations for VAT, GST, sales tax, fiscal representation, IOS intermediary services, and we provide those services in over 77 different countries. We also can help classification of products for customs duty and import VAT. And we're most famous for our tax engine, so calculating the right rate of tax at the point of sale, at the point of invoicing, through our Avatax product. That covers sales tax, VAT, GST, customs duty, as well as insurance premium tax, IPT. And we actually had close to 40 billion calls to our Avatax API in 2021. We also are involved in e-invoicing, following an acquisition of Imposia about 18 months ago. So we can now provide compliant tax and e-invoicing in around 60 different countries around the world, across business to business, business to consumer, and business to government. We're an accredited PEPL access point provider. And then finally, we prepare VAT returns, either as a managed service, but also through our SaaS VAT reporting solution. And again, in 2021, Avalara actually processed more than 4 million indirect tax returns. So I'm just going to kick off by a few anniversaries, because the last couple of months and the year ahead actually has some quite meaningful anniversaries. The first one, 10 years, is PEPL. If you haven't heard about PEPL, you certainly will do in the year ahead. So PEPL was first set up by the European Commission to create a single European network to share e-invoices within the public sector. But today it's very much a global standard and a global e-invoicing network, which has spread to Australia, New Zealand, Singapore, and Japan, and that will spread much further afield. It's also 30 years since the creation of the EU single market. That was set up on the 1st of January 1993. Of course, because of Brexit, the UK is no longer part of that single market, but UK businesses, or indeed any business trading within the EU, will still be faced with VAT legislation arising from that single market and the common rules. And then finally, it's 50 years on the 1st of April since VAT was introduced in the UK. So on April Fool's Day in 1973, the Chancellor, Anthony Barber, announced VAT as a simple tax. And I think most people on this webinar today would agree, 50 years later, we've kind of found out that it's not so simple. It's constantly evolving. There are complexities. And what makes it even harder for businesses and advisors is there's now a VAT system in over 180 countries around the globe. So, as the world becomes smaller, through increased supply chains, globalization, and technology, businesses suddenly have to get to grips with complex, changing, evolving, and different VAT rules around the globe. So I'm now going to pass over to Reece to kick this off by looking at some of the major rate changes for VAT GST over the last year. Thank you.
Thanks, Alex. So what I want to do is start just with a high-level overview of some of the rate changes this year. There's been a number of countries that have increased their VAT or GST rates. Some countries have actually decreased them, which is not a typical trend that we see. And then there have been a couple of countries that actually introduced VAT this year. So starting with the increases, I suppose the key one on this slide here is Singapore. They have increased it from the 1st of January from 7% to 8%. But do bear in mind that will actually go again to increase again next year to 9% at the start of 2024. Other countries you can see all typical slight increases. Maldives, if you're lucky enough to go on holiday there this year, you will see the tourism GST actually increase by 4%. So they are trying to claw back some of the lost revenue that they may have lost over the last couple of years. As I mentioned, some countries have actually decreased their VAT rates this year. Luxembourg are doing this on a temporary measure. So throughout 2023, the standard rate, intermediate reduced rate, and the reduced rate will all be decreased by 1%, but that standard super reduced rate will remain at 3%. And as you can see, Mozambique and Uzbekistan as well have also reduced their rates. And then finally, not very common for businesses, but Palau and Suriname have also introduced VAT this year, and both introduced that with a standard rate of 10%. So yeah, just a high level overview of some of those rates, but bear in mind if you do, if you're selling in some of those countries, then make sure that your systems are all up to date, that you've got the latest systems VAT rates in there for calculation purposes as well. Moving on to the UK, more familiar for most people on the call, there has been a change to the penalty regimes made by the UK Tax Authority, HMRC, and it's kind of split into two. So there is a change to penalties for filing a VAT late, a return late, but also if you're actually paying that VAT late as well, there is a change in the way you will be penalised. So if we start with filing a VAT return late, I believe this is a little bit more lenient than it was before. They've now got a penalty point process similar to maybe your driving license, and the limit of points will be dependent on the submission frequency that you have. So if you're monthly, you have a limit of 5, quarterly is 4, and annual is 2. What it means is every time you have a late filing, there will be 1 penalty point added to your record. And once you reach the limit, you'll then start getting charged a £200 fine for every VAT return that is late. This is a rolling 24-month period, and it can be reset, but it has to be consecutive returns that are filed on time. So for example, if you're monthly, you have to file at least 6 months VAT returns on time to be able to reset your points, your penalty points. The one that I think is a little bit more aggressive is the paying VAT late. Now, there is a 15-day leeway where you don't actually receive a penalty. So if you are late by 15 days, then there will be no penalty, which is good news. However, if you are late between the 16 and 30 days, there will be a 2% penalty due on anything you owe at the day 15. If that extends to 30 days, there'll be an additional 2% owed. So in total, 4% that you're paying. And then every single day after that 30-day period, you'll be paying a daily 4% VAT rate. A penalty on the VAT that's due. On top of that, there are penalty interest charges as well. So the UK HMRC have said and stated that it's 2.5% above the UK base rate, which actually is currently at 3.5%. So if my math is correct, that is 6% late penalty interest charge on top of the penalties that you are paying. So it's more important than ever to make sure that you're not only just filing your returns on time, but also you're paying that VAT on time as well. If we move on, just to finish off on MTD here as well, obviously the UK government has confirmed at the back end of last year in November that you can no longer use the legacy VAT online account to file those quarterly or monthly VAT returns. So everybody now needs to be signed up for Making Tax Digital. All VAT registered businesses now need to be filing under the new MTD process using functional compatible software and being able to file those VAT returns on time. Going back to what I was just discussing, if you're not signed up and you're not readily available on a compatible software, you're going to be filing late VAT returns, which could incur penalties. Just also remember that there are kind of 3 areas of MTD. You have your MTD filing process that I just mentioned, but there are also the digital records piece. You need to make sure that you are capturing and storing those key fields and information on your transactions. And there are digital links throughout the journey of you creating your VAT return. In other news, in Croatia, they have adopted the euro from the 1st of January 2023. So they have replaced the Croatian kuna with the euro. What that means for VAT purposes is that all future Croatian invoices now needs to have the euro added onto that invoice and replaced. On top of that, if you are raising invoices in Croatia in another country, in another currency, sorry, you will need to convert that into euros. Like other euro countries, you need to be using the ECB, the European Central Bank rate, their daily rate, to be able to do that conversion. Just a note on here, if you are doing business in Croatia, then make sure that, again, your systems are all up to date to ensure that you're reflecting the euro currency. Your invoice templates are up to date as well, again, showing the euros, and also any FX that you may have is also kept up to date. If we then move on slightly to, if we go to Singapore, they've actually released a GST on low value goods. This is a common trend that we're seeing globally. We've got in Europe, we've got the import one-stop shop. We have Norway, Switzerland, Australia, New Zealand, a number of countries moving towards this. And it's really because the global e-commerce trend that we're seeing, each country is trying to get a piece of that pie. And Australia have actually raised, as you can see on the right-hand side, around 760 million in GST just by adding in the low-value import goods reform. So in Singapore, as long as you're meeting the turnover and the revenue test that you can see on screen, so it's $1 million Singaporean dollars turnover and at least 100,000 value of B2C suppliers of low-value goods in Singapore, then you do need to meet this requirement. What it means is if you're moving goods outside of Singapore and you're selling them into Singapore, and they're under the value of 400 Singaporean dollars, then you will need to charge VAT or GST on those transactions. And it's also applicable for marketplace deemed seller rules as well. Now, the only slight tweak to this that's different from many other low value goods reforms that we're seeing is this is actually on an item by item basis. So a lot of countries are doing this on the invoice totals. In Singapore, this is actually on each item within an invoice. So you may have 4 items at $250 that equals 1,000 invoice. Because each of those items are under the $400 threshold, that means that GST must be charged on all 4 of those items. Note here that Malaysia are also introducing something very similar, and that's going to be from the 1st of April 2023 as well. And then finally, New Zealand. New Zealand is, this is currently in proposal stage at the moment. It's looking to be the 1st of April 2024. They are extending their GST marketplace rules to also capture additional types of services. That is accommodation, ride sharing like your Ubers, food and beverage delivery services as well. What this means again is as if that electronic marketplace is above the GST registration threshold, then they need to start charging GST on these types of services that they're supplying via their electronic platform. What this means for people in New Zealand as well is that there's going to be an additional charge of GST. The likelihood is because before you may have individuals that are maybe under the 60K registration threshold with no GST charged on letting out their homes. If they are now letting it out on an electronic marketplace, GST will be applied.
Very interesting, Reece. I mean, this is certainly a global trend. We've seen very similar rules come into play already in Canada for GST, HST, and actually very similar to the proposals the European Commission have put out under VAT in the digital age VIDA. So definitely a trend here, and almost just a natural extension of the marketplace rules that are already in place within the EU, within multiple countries around the world for goods.
Yeah, really good point. And I know you're going to be touching upon VIDA later on in this slide deck as well. So yeah, look forward to hearing from that. Finally, on New Zealand as well, on top of actually charging GST on these platforms are also going to be starting to ask to provide more information on the sellers on their platforms to Inland Revenue as well. So there could be quite a lot of change there in New Zealand. Okay, I'm going to go across to the US now and just touch upon economic nexus, because this is really touching many businesses that are trying to sell on economic e-commerce platforms into the US, and they may not be aware of these economic nexus rules. This is something that came about from the Wayfair case back in 2018. And what essentially it means now is if you are selling into the US without you may not be established there, but economic nexus basically means you will need to start registering for sales tax and charging sales tax on those suppliers. Over the last couple of years, the number of US states that have added economic nexus to their requirements has now reached 45 US states. And Missouri was the latest one at the start of this year that's added to it. What this means is, if I go on to the next slide, you can see here this is a map of obviously the US states, and the economic nexus thresholds does differ per state, but the ones that you can see in light blue are the ones where you can very quickly become breaching that nexus threshold and very quickly having to start to register. It is 100,000 threshold or just 200 transactions. So if you're an e-commerce seller selling into a certain state, New York, for example, you may be breaching that threshold quite quickly. So there is complexity around the nexus thresholds. And if we go on to the next slide, what you can also see then is the values. These are how you actually make up that revenue to determine whether you are breaching the nexus thresholds. If we look at Texas, for example, this is actually based on your gross sales, which could include exempt transactions. It could include zero-rated transactions, but it also includes, as you can see here, any sales made for a marketplace. So very quickly, you could be breaching nexus, and you may be selling a lot of transactions are actually exempt from tax, but you still need to register and be compliant in those states as well. So very complex. We do have a nexus study that we can support you with if you or your clients believe you may be breaching. We can look at your nexus study to understand exactly where you may be breaching, but also if you have breached, you may need to do some voluntary disclosures across certain states as well.
Thanks, Reece. I think this is really interesting, and it's very similar to the e-commerce trend we're seeing. The fact that the customs border no longer provides a safety net, no safe harbor. So, in the US, regardless if you have business customers, it's just B2B, and they are the importer, they're clearing goods across the border, they're paying customs duty. Because sales taxes in the US are at a state and local level, the federal customs border has no implications at all. So, just the fact you're selling to customers in the US, you're receiving revenue from them, you are caught within these economic nexus rules. And again, interesting about the gross sales. So, there may not actually be any tax due. You may have obligations, to obtain resale exemption certificates, for example, very similar to requesting and validating a VAT number for intra-community trade. But of course, in the US, even if there's no tax to actually pay, you still need to register, you still need to file. And, the statute of limitations don't kick in until you register. So, it's a very prudent thing to do. Monitor your sales, monitor that by state. And then, as you're approaching those thresholds, do reach out for help, support, register, and then be compliant.
Good. Thanks, Alex. I'm going to pass back to you now to talk through some of the e-invoicing mandates for 2023. And obviously, it's more and more countries are moving towards e-invoicing. So really interesting to hear around this area.
Thanks, Reece. Yeah, so, absolutely. E-invoicing is the clear direction of travel we're seeing for tax authorities within Europe and across the globe. And although this is very much future-looking, I always like to look at the past as well. So if you look at the last decade, most of the e-invoicing reform mandates that have come in have really been outside of Europe, predominantly Latin America, South America, starting to spread in APAC. But Italy's really only been the sole European country to mandate e-invoicing back in 2019. And, we've seen a lot of e-reporting, SAFTs, additional ledgers, additional filings as tax authorities look to get transactional data. But really, if we look forward now, it's clear e-invoicing is coming to the EU. This year, Saudi Arabia, the Kingdom of Saudi Arabia, will be implementing its phase 2 of its Fatura. We're going to look at that in a bit more detail. Serbia, another European country that will mandate e-invoicing. In fact, it did from the 1st of January this year. And then, all eyes on next year, really a game-changing year. Poland, France, and Spain all mandating e-invoicing, issuing and receiving of invoices in a structured data format, meeting local standards, specifications, and formats. And that's huge. That means by next year, almost 50% of GDP in Europe will be covered by e-invoicing, and not a lot of time for businesses to prepare. And then looking ahead even further, it's not a question of if, it will be when European member states also mandate e-invoicing, all the way up to 2028, when we will see compulsory e-invoicing and real-time live reporting for all intra-community supplies. So that's part of the draft directive under VAT in the digital age, VIDA. Still needs full agreement and to be passed into law, but that's certainly on the agenda. And just to add a bit of context, why tax authorities are introducing e-invoicing, it's to give them visibility on every transaction. Everyone's trying to raise revenue, reduce the VAT gap, spot and stop fraud. And really, VAT returns are too little too late. Summary data every month, every quarter, in some countries, annual. And tax authorities want to actually step in the middle, between suppliers, between the customer, so they can get full transparency, full visibility, and most important, a full and complete data set. They can run checks, validations. They can actually, in some cases, clear that invoice, give approval for it to be issued. In some countries, the tax authority have full visibility before the customer even sees an invoice. But longer term, this gives tax authorities the ability to run AI, advanced analytics, even apply machine learning, and we're starting to see that in South America already. So just a quick update in Australia. So Australia hasn't mandated e-invoicing, but is certainly encouraging it. It's adopted PEPL, so really leveraging the European standard, slightly adjusting that for the GST model in Australia. And the interesting thing here is the government are actually offering an incentive for businesses to use PEPL for B2G invoicing. So all Commonwealth agencies in Australia will now pay an invoice within 5 days if that invoice is supplied electronically on the PEPL network. We're going to see more and more businesses adopt e-invoicing this year. And, really we're going to see a network effect too, because, as more and more larger enterprise level businesses join the network, they will want to interact with their customers this way too. So, bringing more and more SMEs into this invoicing network. There was an idea of a business e-invoicing right slated for this year from the 1st of July. Under this proposal, businesses would actually have the right to request that their supplier issues them with an invoice electronically. So actually the opposite of the current rule in Europe, where the buyer, the customer, needs consent. This is actually saying that the customer has a right to receive an e-invoice if they want to digitalize and automate their process. My understanding at the moment from recent discussions with the ATO is this is probably parked. It hasn't necessarily gone away, but I think we're going to see, other initiatives, other ways of trying to attract businesses to digitalize. Very similar in New Zealand. So there's been a joint approach with Australia on e-invoicing. So again, adopting PEPL, and there is a joint working group, seeking interoperability between the countries, and again, seeking best practice. And pretty much the same story as Australia. Businesses are starting to join the network. But again, if you're doing business in New Zealand, this will be the year where we see the network effect. More kind of larger vendors and customers, will start using PEPL, and will probably incentivize their trading partners to do the same. Ironically, we may actually see a relaxation in the formal GST tax invoicing rules in New Zealand. There's a proposal now to replace the requirement to hold formal GST invoices, providing less prescriptive requirements, and allowing more documents to actually qualify as a document for GST purposes. So that should come in to place this year, originally postponed from last year. And another recent update there, just on the invoicing side, if you operate self-billing, or you're looking to, that no longer requires pre-approval from the New Zealand authorities, the Inland Revenue. That came in from last year. Staying within the APAC region, huge reform in Japan. So historically in Japan, there hasn't really been a concept of a tax invoice, and the input tax credit mechanism in a formal way. Other documents and accounting records have been used to evidence Japanese consumption tax, JCT, but we're suddenly going to see a big change. Businesses will be required to retain what will be known as qualified invoices, or qualified tax invoices, that meet certain requirements around content and format. Those will be needed to actually claim input tax credits, as well as the supplier being required to retain those evidence on file. So businesses that will issue these invoices will need to register to become an issuer of qualified invoices, and the deadline for that registration process is actually the end of March this year. But actually, at the same time that these rules come into play, the 1st of October, we are going to see the launch of e-invoicing in Japan. So no mandate, but again, encouragement to get Japanese businesses using e-invoicing, using this new PINT specification. So again, using PEPL, but using an international version to meet local Japanese requirements. And already we're talking to a lot of customers and clients, and a lot of people are saying, okay, we need to raise invoices for the first time that meet these requirements. Let's hit the ground running, and let's use an e-invoice. Saudi Arabia, as I mentioned before, moving ahead with phase 2. There's going to be different waves of businesses that need to join at different times. ZACA, the Saudi authorities, will inform businesses individually, when they need to comply. And they've said they'll give at least 6 months notice. So at least there is notice there for businesses to actually integrate and test their solutions. The big difference under these requirements from the more generic e-invoicing rules in phase 1 that came in, the invoicing software will need to connect to ZACA. So that invoice will need to be submitted to the government portal. There'll be verification codes that come back in the form of a QR code, which will then need to be shown on that invoice. Something else to look out for there, there are local storage requirements. So e-invoice data needs to be stored within the Kingdom of Saudi Arabia. Quite a challenge for a lot of multinational businesses, maybe using cloud, maybe using servers in a central location. Avalara has had to deal with this ourselves. we have had to find local hosting for our e-invoicing solution there. Serbia, as I said before, a European country implementing mandatory e-invoicing. That kicked off from January this year. This follows a similar business-to-government mandate that came into play last May. UBL 2.1 standard meets the European e-invoicing standard. You'll hear a lot more about that standard as VIDA, Fast in the Digital Age, progresses. You do need to appoint a local information intermediary if you're unable to connect direct to the system. So still in the early days of that system in Serbia. It's going to be interesting to see, where the pain points are, or if businesses are able to integrate this into their normal business as usual systems and processes. Benelux, so Belgium and Luxembourg, while they're not mandating general business-to-business invoicing, they are both pushing ahead with mandatory e-invoicing for public procurement, so business to government. Luxembourg has done this in a phased approach based on the size of individual businesses. So even smaller businesses will be caught by this by March this year. So if you have any contracts with public authorities, government in Luxembourg, you will need to submit those invoices in a required format via the PEPL network. And it's a very similar position in Belgium. The difference in Belgium is they are introducing this in a phased approach based on the size of the individual contract with the government department. So phase 2 and 3 coming in this year, 30,000 euros, and then everything else by November this year. Reece, I'm going to pass over now to Portugal. I know you've done a lot of work, with customers and clients in Portugal. Can you give us a bit of an update what we're seeing there?
Yeah, so and thanks, Alex. There's quite a few changes that's already taken place and will be taking place in Portugal, and it's more relating to the normal invoicing process. So it's not actually invoicing today. Last year, they released the requirement to add the 2-dimensional QR code onto every single invoice. So that is now a requirement. It's been in place since the start of last year. In addition to that, there is a code which is called the ATCUD code, which is a unique document number. This has been delayed for the last couple of years, I think, but it's now a requirement since the 1st of January of this year. And it also applies to non-resident Portuguese VAT registered businesses as well as established as well. So this ATCUD code needs to be included on all invoices in Portugal, on top of the QR code as well. The ATCUD code is a series of numbers that is actually issued by the tax authority, and you can obtain that via an API. Once you have that series, then you can include a sequential numbering sequence on top of that ATCUD code. So that needs to be added onto every single page of an invoice, and that has to be immediately above the QR code. In addition to that, there's a couple of other requirements. So there is going to be a mandatory to actually apply a qualified electronic signature on all PDFs, but that has been postponed until next year, so the 1st of January 2024. So that's the current time frame for that. And then there is also the invoicing monthly SAFTI for Portugal. There are a number of SAFTIs in Portugal. This one is the invoice monthly, and that needs to be created by your certifier invoicing software as well. So quite a lot of moving parts in Portugal. It's not e-invoicing, but it's more around your existing kind of PDF process, but just adding those additional information points on there as well. So I think that's hopefully enough for what's to come this year. To kind of add more requirements to the list that you may need to cover. We're also looking at 2024 and beyond as well, because There are some key countries, as Alex mentioned earlier, that are actually moving towards e-invoicing next year. And these countries are, there may be quite high presence in these countries, and we obviously believe that this should be looked at sooner rather than later, so that you're ready to meet these requirements when they go live at the start of next year. The first is Poland. So Poland are introducing a new e-invoicing mandate. They're actually looking to kind of copy the success that we've seen in Italy with the SDI e-invoicing requirement, where essentially all invoices need to go via the authorities for effectively a stamp of approval before they then get moved on to the final consumer. So they have launched the KSEF, which is their national system for e-invoicing. And as I mentioned, this is a two-way process where Polish taxpayers will need to issue their invoices via the KSEF, but also they can receive back structured, and when I mean structured, like an XML, for example, invoice back into their ERP system. So this has started. We're currently in the voluntary stage at the moment, and that started from like the start of last year. So businesses can and are already using this on a voluntary basis, but that can be used in parallel with your existing paper processes as well. But from the 1st of January next year, this will become mandatory, and all B2B invoices will need to go via this portal. Just to note, this is currently only for companies that are registered and established in Poland today. In terms of what this looks like, it is going to be a structured invoice, so it's in XML format and it follows the FA VAT structure. As I mentioned, invoices will be sent via the KSEF portal. Avalara is a certified provider for Poland, among other countries, and you would need to use some form of software to be able to convert data from the source system into the applicable XML format, which is the FA VAT, and then send that to the authorities. That will then get passed on via the authorities to the final business consumer. The great thing about this, though, is, and you can see this on screen here, is you can log into KSEF and you can actually obtain and download a standard invoice that's actually been created by KSEF, and every single invoice in Poland will now look identical. But you'll have all the information, so it becomes a readable format if you aren't able to, like many people, have to read an XML format. That can also be passed back the PDF as well as the XML into the source system, so you can obtain that readable format as well.
Reece, I think this is really interesting, and you know, maybe I'm a bit of a geek, but it was quite exciting to see this being generated. So this has actually been generated in the KSEF test environment, you know, using our own data. But you know, we converted data into the right format. We sent it to the platform. You know, we've then gone in, you know, downloaded this. It is quite strange to believe that every invoice in Poland will be identical. You know, it is going to be self-generated by the KSEF platform. So it's going to be a very big change to business process. You know, businesses in Poland will need to make sure their data is complete, it's in the right format. You know, everything is passed, including, you know, foreign currency, you know, the Polish zloty equivalent. Yeah. At the moment, this document only seems to be available in Polish. You know, I don't know if that may change in the future, but it's something to be wary of. You know, this is a big change. It's a big change how Polish businesses will interact with their trading partners, but it may also impact much wider than just domestic sales, because even though, you know, it's going to only be Polish businesses that are able to log in, retrieve this invoice from the system, you know, we're actually seeing a much broader scope, particularly in the draft VAT Act that's just been released, you know, by the Polish authorities, which, you know, appears to be a lot more than just e-reporting. You know, we are seeing invoices being registered in this system, and we will envisage, you know, the suppliers will actually download this copy of this invoice and share this, with counterparties, even if outside of Poland. But definitely something for all businesses to consider. If they certainly have a presence in Poland, time is starting to run out. To find a solution, integrate and test, as well as all the communications that you'll need to do, with suppliers, with customers.
Thanks, Alex. And one final point I was going to mention on here as well is, although it's not been confirmed by the authorities, it is anticipated that this may replace the SAFTI JPK monthly requirement as well. So that may be some benefit to the new mandate. If we just move on to France, so they're also looking at the same time, in July 2024, to also bring in mandatory B2B e-invoicing. You can see on the right-hand side, this is going to be a staggered approach where large companies will come first and then they will go down to the smaller businesses. But the top line is the most important, because from the 1st of July 2024, even if you're not a large company, you will still need to be able to receive an e-invoice from a large company. So essentially all businesses from the 1st of July 2024 will need to be able to receive the invoices from their suppliers from this date. It's a little bit more simplified than what I just spoke about in Poland, because there isn't the middleware of the French government. However, you will need to kind of issue and receive B2B invoices in a mandated format. This is still being finalized at the moment, but there are a couple of options to be able to send this. So you can use an approved third-party PDP platform. Again, Avalara will be a PDP provider for France. The French government have also provided a public invoicing portal, which is the PPF. However, they have stated that this is for very small businesses only, and it's going to be quite a simple option. So the likelihood is most businesses will need to look for a PDP provider. In terms of the B2B transactions, there's 3 formats that can be used to submit. So that means, again, on the receiving end, you'll need to be able to receive a UBL format, a CII format, or a Factura X format from your suppliers. The Factura X is actually a really interesting format because it's a hybrid format. It's actually a PDF with embedded XML behind the scenes. So you do get the readable layer on that. And Germany have got something very similar with their Zuckford as well. That's B2B. Now, there is also a second layer of e-reporting in France that will also be mandated, and that's actually for B2C and cross-border transactions. So it won't be an e-invoice, but you still will need to send all the relevant information to the authorities via the new e-report. B2B invoicing is currently, again, only for VAT registered businesses who are established in France, but do bear in mind that e-reporting will capture those non-established if they are selling B2C or cross-border transactions. Okay, I'm going to pass over to you, Alex, to kind of give an overview of Spain and Vida as well.
Thanks, Reece. So as I mentioned before, Spain is one of these early adopters of e-invoicing. Last year, Spain passed its growth and creation law, the CREA legislation. So this is not necessarily tax-driven. It's also to digitalize the economy, really help SMEs digitalize their financial processes. And under this mandate, all companies and professionals in Spain will need to issue and receive invoices in an electronic format from 2024. We're seeing a phased approach, based on the size of businesses, based on revenue. So the first, businesses will need to apply in early 2024. We're still awaiting, full technical requirements. This is very different, I suppose, from France, where there is, already technical requirements, brand new e-invoicing platform and regime, being set up. But Spain already has e-invoicing networks, both private and public. It has its FACE platform for public procurement, and the FACE B2B, which can be used for business to business e-invoicing. There's a national standard there, which could be leveraged. But we're actually probably going to see the use of UBL. So it's very similar to France, to Serbia, to a lot of other countries that have implemented e-invoicing. Universal Business Language, UBL, will be adopted in Spain too. But while we haven't necessarily seen full technical requirements for that e-invoicing law, in parallel to that, there is draft legislation looking to regulate billing software. So creating new rules around functionality and accreditation of invoicing software. Certain new data and new features that may need to be added to billing records and invoices, including a hash, QR code, the ability to export data to the tax authority, the AEAT, this concept of very factu. Those requirements are still going through the legislative process and are still subject to change. And a great example of that is, in the very first draft, there was talk of a unique alphanumeric identification code that needed to be added. That has since been removed from the draft legislation. So again, watch the space. We will see more and more clarity, come out from the Spanish authorities. But again, time is running out for businesses to start looking at e-invoicing in Spain. Very quickly, we've mentioned VIDA, VAT in the digital age. So that was released in December, just before the holiday period. Lots of proposed changes there across various different work streams. One of them being the move towards a single VAT return, so reducing the need to have multiple VAT registrations for trading across the EU. Under the proposals, the one-stop shop will be leveraged and expanded for more use cases, including domestic sales, business-to-business sales, as well as movement of own goods, movement of inventory between warehouses, reducing the need to obtain multiple VAT numbers in different EU member states. We're also seeing a proposed extension of marketplace deemed liability. That's currently in place for the one-stop shop for distance selling within the EU, but that currently only applies to non-EU sellers. Under this proposal, that will equally apply to EU sellers selling on marketplaces too. And then, the big announcement that got most of the headlines was around e-invoicing, moving to mandatory e-invoicing, meeting the European e-invoicing standard from 2028, so in 5 years' time. That would also come with close to real-time reporting of the data, so a subset of that invoice to the local tax authority, with symmetrical reporting by the counterparty, by the customer. So an end of EC sales lists, but the replacement of granular real-time e-reporting, a new digital reporting requirement underpinned by mandatory e-invoicing. We're currently within a kind of public consultation stage. Feedback has been requested by the European Commission. This will be collated, analysed, presented to the European Parliament and the European Council with the aim of feeding this into the legislative debate. The latest update on that consultation period has been extended now to the 21st of March. We finally had that draft directive published in all European languages. We've had some questions in saying, will VIDA and talk of this European e-invoicing standard delay some of the existing mandates? I don't think so. If you look at France, France's formats for next year are all based and compliant with the European standard, just different formats that are being used. It may be, after 2028, those countries may have to slightly tweak their models. For example, pre-clearance models are specifically ruled out under VIDA. But I think we still have a long way to go. This still needs to be debated. It still needs to be passed. We still need unanimous support within the European Council. And at the same time, the European standard that's already in play for business to government public procurement, it also underpins the PEPL standard, EN 16931. Work is being started to update that. Is it still fit for purpose? It was designed, many years ago. It was designed for public procurement. So, does it still meet all the requirements for day-to-day business? Does it need to be extended? Are there data fields, commercial, legal, even marketing information that we currently see on invoices today that we may need to put into this European model? So I did a bit of calculations, and I was just working out how many working days are left till 2024. Maybe seems a strange thing, when we're getting back to the office, after the holiday period, maybe just getting to grips with a lot of the changes that have just taken place or coming up later this year. But with all of these changes that are coming up, particularly in France, Spain, Poland, and beyond, really businesses need to get a grip now. Are they aware? Do they have visibility on these changes? This advanced knowledge is key. It provides people, different stakeholders within the business, more time to prepare, but also to budget, maybe carry out vendor selection, implement. The key thing here, I think, is it's not just a tax change. It's really aligning with business processes, and it's going to impact, almost every single department, within a business. Very similar to the kind of projects, I worked on when the Gulf states implemented VAT. It's looking at every system, every process, every department, every stakeholder that's impacted. All the different mandates do look different. I do appreciate that. That's maybe something VEDA's, looking to resolve, but do look for the synergies. Look at the similarities between them, and then just try to identify what the differences are. And then, finally, look at this strategically. Start developing a global strategy. How do you respond to this? My view is the days of just finding a local solution, a sticky plaster approach in country, a little update, a little patch, a small bit of local software. It's not really fit for purpose, when this is a global trend. So start thinking holistically, globally, start looking for a kind of single, scalable global solution. And this isn't meant to be a sales pitch at all. This could be any e-invoicing solution, but just trying to show, how this, would interact with systems and processes. You want this to be as close to business as usual as possible. So, taking data from your systems, converting it to the relevant format. Reece talked about various different standards and formats, in Poland and France, in Spain, in Italy, converting that to the right specifications, and then submitting it to the right platform, the right portal, whether that be direct to the government or tax authority, or direct to the customer. But also consider things like archiving requirements. In Saudi Arabia, as I said, those have to be stored locally. In France, with the new mandate, PDPs will have to ensure that they meet the new SecNum cloud cybersecurity requirements. So probably a local cloud in France. So lots of complexities there, lots to think about. But the global world of indirect tax will continue to evolve. I think we're almost on the hour now. So thank you ever so much for joining us today. It's been a real pleasure. If you've got any follow-up questions, you'd like to chat to us about anything we've talked about, maybe you'd like to learn more about Avalara, our solutions, maybe explore e-invoicing, do reach out. Our contact details, email addresses are on the slide now. Again, follow us on LinkedIn. We often share blogs, ebooks, other thought leadership. But again, thank you very much.